Economist, chairman of Roubini Global Economics, and professor at New York University. That's Stern School of Business. Nouriel Roubini joining the conversation with Anthony Scaramucci and myself. Nouriel, good to see you.
Great seeing you.
Thank you so much for joining us. To what do you attribute this market meltdown in 2016 so far? It's
a combination of factors. One, there is worries again about China hard landing, a collapse of their currency and the stock market. I think those risks are overstated. It's going to be a bumpy landing, but the market believes in a hard landing. The U.S. economy is slowing down, actually, and the Fed might have made a mistake of starting rising rates in December. You have the turmoil in the Middle East, and the Shia-Sunni conflict between Iran and Saudi Arabia is becoming a problem. You have this collapse of oil prices that should be good for the global economy because you're redistributing income from savers to spenders, but it's bad because one is not just a supply story any longer, but concerns by the market. There is a weakness of global aggregate demand, of growth in China, in emerging markets, in the United States, and so on. And there are now stresses in credit market, as many of these companies have borrowed too much in the oil and energy sector, might be going bust. On top of it, top-line revenues and bottom-line profits are slowing down, given what's happening in the world. So it's a combination of factors.
What metrics do you look at to indicate, okay, the worst has been done, okay, it's perhaps getting to be an overreaction, or are we way not near that at all yet? I mean, these markets have to settle out and find I guess, a stability point, a bottom?
There are two factors going to matter. One, the economic data. Will the data from China stabilize? And at this time of the year, they're murky because you have the Chinese New Year. So until the end of next month, it's going to be very hard to make sense of it. Two, in the United States, again, the data are murky. The traded sector, manufacturing, is weakened because of the strong dollar, because of falling energy prices. But the non-traded sector has been doing well. The labor market is doing well. The GDP number is not doing well. So until we have this residual seasonality out of the U.S., out of the way, we're not going to know. So the economic data are one factor, and more importantly, is going to be the policy reaction, because in the past, the bad news on the economy are good news for the market because they are leading to expectation of endogenous policy response. If the PBOC were to act, if there is a fiscal stimulus in China, if the Fed signals they're going to wait beyond March towards April or even June, whether the ECB and the BOJ are going to do more monetary easing, that might start to calm the market. So far, we're not seeing the policy response.
If you were the policy czar for the world, which I think you should be, I'll declare that today, what would you do right now? What are some of the steps you would take in China, the United States, and here in Europe?
I would say it's a combination of things. I'd say that both in advanced economies and emerging markets, structural reform that increase potential growth have to occur because potential growth has fallen, but those things take time. Secondly, you have to boost short-term economic growth and aggregate demand. So far, we've been relying a little bit too much on unconventional and conventional monetary policy, not enough on the right types of fiscal policy. For example, the IMF is saying we need infrastructures, not in China, but in US, in Europe, in other emerging markets. Maybe that type of fiscal policy helps you on the aggregate demand, but also on the aggregate supply, because it increases the productivity of the private sector. And we have to continue, unfortunately, with unconventional monetary policy, because in a world in which the structure is occurring slowly and fiscal is constrained by politics and markets, the only game in town is going to be still monetary policy.
I think this is a really important point, and what you bring up in terms of what the reaction is. I mean, Nouriel, if the Federal Reserve in 2016 comes out and says, you know what, they won't admit that they made a mistake at the end of the year, but just making a move to lower interest rates, would that be perceived by the markets as a negative? Or do you think that that would be perceived as the markets as, okay, well, now we've got more stimulus? And I recognize you're saying it's more than monetary policy. We need structural change in terms of fiscal policy. But on the Fed question.
Well, on the Fed question, I would say I don't think they're going to cut rate back to zero. But at this point, they've been saying, based on the dot plot, they're going to hike rates 4 times this year.
Never going to
I think that in March, we're not going to have a hike. We're not going to have a hike even in April. At best, we might get 1 in June and 1 in December, 2 hikes. And what's happening right now is that the fall in oil, energy, commodity prices is another leg down on headline inflation, and the market correction is leading to a weakness of sentiment of economic activity. So the Fed has to go more slowly.
It's a cycle.
And as long as they go more slowly, I think the market might calm down. If they keep on saying, in spite of what's happening, we're going to hike in March, I think the market reaction will be severe. But already Bill Dudley has been saying that the inflation is too low, and it's a single wink-wink that we will not hike in March.
The Dow peaked at about 14,000 in October of 2007. Are we going back to that right where we were pre-crisis?
I don't think that today the situation is a repeat of 2008.
You don't?
There is less
Okay.
leverage in the system, there less tail risk. Of course, there is a combination of things can go wrong in the global economy, but in order to get a global recession and global financial crisis, you need a collapse of China, there is then a collapse of their currency, a collapse of currencies in emerging markets, balance sheet effects, recession in China and emerging market, and then the spillover more than through trade will be through financial contagion. If you have a real hard landing of China, we're not going to have a 10% correction in global equity like right now. We're going to have a 20% or more, a bear market, that can actually tip over the U.S. economy.
But they have a lot of policy tools at their disposal in China to prevent a hard landing. Is that fair to say?
Yeah, I would say they still have the policy tools. They can do more monetary easing. They can do certainly fiscal easing. They can do more structural reform. They can manage the exchange rates. They can manage the stock market. They made lots of policy mistakes, and I've been able to communicating that. But the data out of China, the PMI, suggests the growth maybe is in a 6% handle this year. It's not 4 going to 0. It's 6 going towards 5% in the next few years. But markets now have gone from excessive optimism about China, soft landing, 7% growth, to the extreme opposite of pessimism of saying growth is already at 4, they're lying, they're cheating, it's going to go to 0.
Okay.
I think the extreme pessimism, hard landing is not warranted. It's a bumpy landing.
The oil prices are giving them some evidence of that, though, too, right? Because there's been basically a global slowdown, but specifically there.
Yeah, absolutely.
Where would you point to growth in the world right now? I mean, let's try to find, I mean, whether it's places to hide or an area that is not necessarily in the thick of this massive market and economic meltdown that we're seeing.
But the latest forward-looking indicator suggests that actually, paradoxically, 2 regions of the world that are doing slightly better than the U.S. among advanced economies are the Eurozone and Japan, while the U.S. has shown slowdown. China and most emerging markets, maybe with the exception of India, are suggesting also economic slowdown. So what is happening right now is that starting in October, there was a beginning of a global expansion. Positive growth was accelerating, but now the shocks are coming from financial markets and from the oil prices are suggesting that expansion might go back into a slowdown, meaning growth that is positive are slowing down globally, and eventually even Eurozone and Japan are going to be affected by the stock market crash, by the weakness of China and emerging markets. So unfortunately, you could have a negative feedback between financial condition tightening, making the economy weaker, leading us to a slowdown, and a slowdown leading to another rundown in asset prices, and therefore the only savers that can come to the rescue of the market might be, unfortunately, again, central banks. But those central banks so far are not moving.
Central banks, but let's not forget fiscal structural reform, like you said, going into the U.S. presidential election. I mean, you've got, certainly on the Republican side, all of the candidates with tax reform plans. Would that be the kind of event that would move the needle on growth?
But first of all, we don't know who's going to be the candidate. We don't know whether a Republican is going to win the election or whether it's going to be a Democrat, most likely Hillary Clinton. I don't think that the electoral noise is going to have an impact in the short run on the economy. And we'll see what happens after the election. If Hillary Clinton were to be elected, we'll still have divided government because she's going to have the White House. She might even regain the Senate, but the House is going to be in the hands of the Republicans. In that scenario, even the U.S. has to do structural reform.
Right.
Entitlement reform, immigration reform, corporate tax reform, and so on and so on. The question is whether we can go back to bipartisan policy in the United States. As long as we have divided government, that's quite unlikely.
It sounds like 2016, you think things get worse before they get better in terms of markets, Nouriel.
For now, yes.
Yeah.
I would say this episode is a confluence of a whole bunch of factors, and unless there is aggressive policy reaction, and the only game in town so far is monetary policy, with some maybe sprinkle of fiscal policy in the parts of the world that have fiscal space, we might actually see this turmoil in the market being going on for a few months.
Nouriel, thank you very much for